Welcome back to Alpha Recap, your end-of-day sector wrap from stockalpha.ai. Markets closed, and we're here to unpack the rotation we saw across utilities, energy, tech, and, yes, a few sectors that had a rougher day. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Today felt like a day of selective rotation, rather than a headline-driven rally. Some clear winners, infrastructure and renewables, and some real headline-driven trouble spots, like parts of media and crypto.
Exactly. So what really stands out here is that Portland General Electric stepped in with a $1.9 billion proposal to buy Pacific Core. That was the kind of concrete M&A that pushed utilities into the outperform camp.
Right, and that bid, coupled with PJM selecting a 300-mile transmission build, gave investors something tangible to hang their hats on. Not just promises about green energy, but actual balance sheet work and contracts that lead to revenue visibility.
And renewables had nice evidence of maturation today. Terra's solar plus storage project achieved initial grid sync, and Octopus committed $1 billion into California projects. Those are moved from construction to operations moments.
Those milestones matter because once a project is synced to the grid, construction risk drops, and you start seeing cash flows. For investors, that means the valuation debate shifts from will this finish to how much will this earn?
Meanwhile, tech held up around AI signals. Google confirmed I/O for May 19th and 20th, and there was more chatter about Apple testing AI-capable wearables. Those calendar and device queues kept momentum in cloud and hardware suppliers.
Yeah, absolutely. Product timelines like I/O are catalysts. Developer announcements, cloud upgrades, ad and enterprise signals. And device rumors about Apple can re-accelerate hardware cycles, which feed semiconductors and peripheral suppliers.
But it wasn't all rosy. Communications and media ran into labour and regulatory noise, staff strikes at the Writers Guild West, and more M&A drama at Warner Bros. Discovery compressed visibility for ad and subscription revenue. Not a great day for content names.
Totally. Labor disruptions are a direct hit to content pipelines. That makes those companies event-driven now. Short-term hits to studio output and longer-term uncertainty on costs and subscriber growth.
Crypto gave us a mixed picture. Institutional flows from big managers were positive, but then Zero Lens saw a $6.6 million TVL collapse, and regulatory probes kept headline risk front and center.
Exactly. One side of crypto is maturing with custody and large-scale products, and the other side still has fragile credit and counterparty structures. It really encouraged a bifurcated approach. Custody first versus high-risk DeFi exposure.
Short reaction.
Big move.
Short reaction.
Not what anyone expected.
Okay, let's dig into the outperformers first. Utilities led the pack on deal flow and infrastructure stories. Portland General Electric's $1.9 billion bid for Pacific Corp was the headline, but the PJM transmission selection was equally important.
For sure. The PJM pick validates long-haul transmission as a critical path for getting offshore wind and remote renewables to population centers. That order of operations, build the transmission, then connect the renewables, creates backlog for suppliers and more predictable returns for regulated utilities.
And the energy sector, especially the cleantech side, benefited too. BHP had a copper-led beat, Terra synced to the grid, and Octopus's $1 billion commitment showed institutional capital was serious about renewables.
The difference between announcements and operated assets is huge. Once projects operate, developers become investable yield plays rather than speculative builders. That's why energy and utilities traded like duration assets with clearer cash flows.
Stable and mixed sectors included materials, consumer, and real estate. Materials had deal-driven pockets, a Moroccan copper acquisition, antimony tests, some silver tailings deals. But it was very idiosyncratic.
Right. Materials were not a broad-based lift. It was project and commodity specific. Same for consumer. Genuine Parts planning a split, SiteOne reporting about a 120% online sales gain, and Pertalabs pushing an AI platform. Good company-level stories, but discretionary demand remains variable.
Underperformers were communications, media, parts of crypto, and select finance names. Labour, regulatory risk, and counterparty shocks really weighed on performance. Not the best group to be in if you wanted calm headlines.
No, and that's where event-driven plays come in. If you're trading media, size your positions small and consider hedges until strikes resolve or deal milestones appear. For crypto, it's all about custody-first products versus small protocol risk.
Let's unpack the cross-sector themes. First, infrastructure and regulated assets were back in focus. Clear flows into transmission and regulated utilities. That suggested investors were tilting to steadier cash flows and rate-based visibility.
And that theme ties into materials and industrials. If utilities are building more transmission, suppliers of cable, transformers, and construction firms stand to see backlog. Expect some MA chatter as utilities try to scale for grid modernization.
Second theme, renewables plus storage graduating from projects to operations. Mterra's initial grid sync and the $1 billion institutional commitment were proof points that projects were rolling into cash flow.
When projects move from announce to operate, risk premiums fall. That's when developers start to look more like yield names. Asset managers with big allocations to renewables become relevant plays as they buy pipelines of completed assets.
Third, AI remained a unifying growth thesis. Google confirming I/O and Apple testing AI wearables kept upgrade cycles active for cloud and device suppliers. But model economics remained dynamic. Cohere's move on a model family was a reminder of that.
Exactly. The takeaway is to be selective in AI exposure. Prioritize software with recurring revenue, cloud providers monetizing compute, and essential hardware suppliers. Product roadmaps can change quickly, so stick to predictable revenue streams where possible.
And finally, regulatory, labour and legal risk compressed across media, healthcare and crypto. The Writers Guild West staff strikes and studio-level production shakeups add volatility to media earnings. Crypto had both institutional interest and DeFi shocks like the zero-lend TVL collapse.
Policy headlines also mattered in healthcare and cannabis. So those sectors were sensitive to rulemaking and state decisions. Headlines tended to move prices more than steady demand signals did.
Moving into the specific highlights we tracked. Portland General Electric's $1.9 billion proposed acquisition of Pacific Core was the biggest MA signal in utilities. That kind of deal suggested scale seeking for grid investment.
Watch the financing terms on that one. Debt structure and regulatory approvals will determine how accretive or dilutive the deal is. Investors should focus on rate case trajectories and visible synergies, rather than near-term commodity noise.
PJM's 300-mile transmission pick was the other headline grabber. Long-haul transmission is central to moving renewables from where they're generated to where they're consumed. Suppliers and engineering firms should see backlog clarity from that decision.
Exactly. That kind of large infrastructure award boosts the whole supply chain. Materials, construction firms, even specialty finance providers that back these projects.
Then Mterra sinking to the grid and Octopus's $1 billion California commitment were classic proof of progress moves for renewables. Those are the kinds of items that let investors start valuing cash flows instead of construction risk.
And on tech, Google's I/O timing and Apple wearables chatter set the calendar for device and cloud cycles. That tends to support semiconductors, cloud infrastructure, and software names that monetize AI.
Crypto's story was a push and pull. Institutional entrants showed maturation, but ZeroLend's $6.6 million TVL collapse and regulatory probes were reminders that DeFi still had fragile corners.
That's why the recommended strategy was bifurcated. Allocate to institutional-grade ETPs and custody offerings, and limit exposure to single-protocol DeFi credit platforms.
Media and labour risk. The Writers Guild West staffing issues and the Warner Brothers Discovery drama compressed content visibility. That made those names more event-driven than usual.
Exactly. When content cadence gets interrupted, ad loads and subscriber growth forecasts become much less reliable. Risk managers were trimming exposures or hedging around key negotiation dates.
Short reaction.
Yeah, that tracks.
Okay, moving into actionable insights. First, overweight regulated utilities and grid suppliers, selectively. Rationale? That $1.9 billion move and PJM's transmission pick lowered execution risk and made near-term cash flows more visible.
How to implement. Tilt toward large-cap regulated utilities and infrastructure-focused funds. If you want direct exposure, look at utilities with strong balance sheets and clear rate case paths, and industrial contractors with disciplined capital allocation histories.
Second, favor renewable developers and yield-producing clean energy assets. Rationale: projects moving into operations cut development risk and support higher multiples for asset-light operators.
Implementation tip. Accumulate developers with operating assets, or gain hybrid exposure through asset managers that are increasing renewables allocations. Watch commentary from big managers. That often precedes capital flows.
Third, be selective in AI exposure. Prioritize software, cloud, and essential hardware. Product roadmaps can shift quickly. Cohere's model pruning was a reminder. So favor recurring revenue and gross margin resilience.
Yes, look for platform vendors with predictable annual recurring revenue, cloud providers monetizing AI compute, and chip and hardware suppliers tied to device cycles.
Fourth, treat communications and media as event-driven trades. Labor and MA uncertainty mean short-term earnings risk. Size positions accordingly and consider options hedges around key dates.
Fifth, use a bifurcated approach to crypto. Favor institutional and custody-first products while limiting exposure to risky DeFi credit platforms. The $6.6 million failure at ZeroLend was a stark reminder.
6. Watch healthcare for a mix of policy pressure and innovation. Insurers and payment rules can pressure margins, but therapeutic advances and AI adoption will create winners.
Implementation. Balance between innovators with clear clinical or commercial paths and diversified healthcare tech names that can benefit from AI-enabled efficiency gains.
Now, catalysts and dates to watch. Google I/O on May 19th and 20th was top of a list. Expect product and enterprise AI announcements. Also watch renewable project commissioning, WGA West strike resolutions, and further crypto regulatory actions.
Don't forget state rulemaking in cannabis and upcoming fourth quarter reports. They can move names quickly. And keep an eye on macro scenarios. Citi's projection about oil dropping towards $60 in certain peace scenarios reminded us to size energy exposure carefully.
Risks and portfolio construction. Execution risk on projects. Policy and regulatory changes. Event-driven volatility from strikes and DeFi shocks. And concentration risk if everyone piles into long-duration utility and clean energy names.
So keep diversification across growth and value. Use position sizing, and consider hedges around big event dates. It's a market that rewarded measurable outcomes today. Visible cash flows, institutional commitments, and product timelines.
Quick reaction.
Honestly, I was a bit surprised by this one.
All right, let's close with the key takeaways. 1. Investors favored durability today. Regulated utility MA and long-haul transmission gave voters confidence in steady cash flows. 2. Renewables continued to graduate from projects into operations, lowering development risk. 3. AI kept tech supported, but selective exposure was the safer path. 4. Media, crypto, and certain finance names remained event-driven and headline-sensitive.
And practical next steps. Overweight utilities and grid suppliers selectively. Favor renewables with operating assets. Prioritize recurring revenue AI names. Hedge or size down media and DeFi exposures. And watch I/O and project commissioning as near-term catalysts.
That's our recap. If you've got questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next close to walk through how these stories played out in earnings and any new headlines that changed the landscape. Catch you next time.